the 5 biggest mistakes stock market investors make. I love doing those videos when I talk about mistakes that people make in the market because I made them all myself. That's why you guys tell me that they resonate with you, because I did the same thing you did. We all pretty much do the same things. And if you can watch my videos and learn them for free on YouTube, then I would be satisfied. And many of you enjoyed the one I did about valuing growth stocks was the biggest mistake value investors make. I mean, many of you guys told me, I can't believe this video is free on YouTube, because it has so many insightful things that it takes years and years for many people to learn. And it's a major mistake that a lot of value investors make. But I believe this one's going to be much better, very different. I'm going to talk about the 5 worst ones. It's going to be very helpful. But such videos, they don't get a lot of views. So what I'm asking from you is, if you do enjoy them, please press the like button and let me know what you think in the comments, okay? And this is the first one. It is by far the worst one, and it really kind of aggravates me, but I see it with pretty much every single newer investor in the market, and there's really nothing wrong with that. But it's the whole mindset of just DCA. So you buy a stock like Walgreens or Nike or whatever, the stock goes down 10%, you buy the dip. The stock goes down another 5%, you buy the dip. Every time the stock goes down, you buy the dip. You say, oh, just DCA, man. Someday the stock will get back to break even, then you sell it and everything will be fine. Now, the only problem is that not all stocks go back to break even. Intel is still not back to its 1999 break even. Walgreens will never get back to break even. Not every stock is going to go back to break even. So you can't just DCA on any stock. You could DCA on a company like Amazon. Amazon isn't going to zero. Apple isn't going to zero. The index or S&P 500 ETF, you can just DCA on this one, but you can't just DCA based on those stocks. But the main reason why you just DCA is because you're scared of losing money. And I always tell you guys, if you're scared of losing money, you're going to lose money. And this is why you're DCAing, because you don't want to lose money. When the stock goes into the negative, you want to reduce your cost basis because it makes you feel better. And now you would be making an emotional decision. Now, the truth is, let's say you're buying, I don't know, Nike at $100. Okay, it goes to 90, you buy the dip because, oh, this is a buying opportunity. But then you're buying a turnaround over here. You're not buying an amazing company that's doing something great. You're buying a turnaround. Now, if this turnaround takes longer than expected, next report came in worse, then you buy the dip again. So maybe sometimes it's worse waiting for the company to prove itself to you before you add more to the company. But most of you guys, you DCA based on the price. You don't DCA based on the change in fundamentals. If the fundamentals are deteriorating, maybe it's time to sell the dip. Not every dip is a buying opportunity. So maybe the reason why I was able to avoid so many traps is because I sold the dip. I took a loss and I moved on. Before the story got worse and the company went down 50, 60, 70%. I have many of those stocks. I'm not perfect, but I was able to correct my mistake early. So if you want to correct your mistake early, you cannot be scared of losing money. You have to have a different mindset. Whenever you guys enter the stock, you believe, oh, I'm going to make whatever, 10x or 15x. You're not thinking about the downside. You're not even thinking about the potential of losing money. You just only want to make money. You only want to hear positive things. Anything that's negative is just noise. This is not the right mentality to have. You have to enter the stock saying, okay, best case scenario, I make, whatever, 5 or 10x. Worst case scenario, I take that 20% loss and move on. And you have to listen to people that are bearish on the stock, because those people might tell you if you're making a mistake and if you can sell the dip instead of buying the dip early on. And this is the kind of, I believe, mindset most of you guys should have. And it says, if I'm right about a stock, I can 2x, 10x, or 100x my money. If I'm wrong about a stock, I learn an important lesson and get a tax write-off. Either way, I win. This is a beautiful, beautiful mindset. But if you enter the stock, well, oh, I'm going to make money. If I'm never going to lose money. If you enter with this kind of mindset of being scared of losing money, you're going to make emotional decision that makes you feel better, which is DCAing on a dying company to lower your cost basis. That's not going to help you. Sometimes you have to be open-minded, realize, okay, the fundamentals are deteriorating. My thesis is no longer the same. I made a mistake. This is the time to sell the dip and move on. So you can't just DCA with any stock. You could do it with the index. You could do it with amazing companies, the Mag 7 or something. But you can't do it with any stock in the market just to reduce your cost basis to feel better, because then you will be making an emotional decision. And not every dip is a buying opportunity. Some dips are selling opportunities, dependent on a change in the fundamentals of the stock and dependent on other opportunities available. So this is what I'm trying to explain, guys. Not every dip is a buying opportunity. And stop acting just based on the price alone, like, oh, if you like it at 100, you should love it at 90. If the fundamentals have deteriorated since, if there's better opportunities, maybe you should sell it at 90. You just have to think about it this way and not being scared of losing money, because all those investors, Buffett and Munger and many of them, they took major losses on stocks. So what makes you think you're going to be perfect? What makes you think you're never going to lose money? That's just impossible. And if you meet someone that never lost money, just give me their phone number. I'd love to talk to them and, see what they did. Okay, now this is the second one, and it's a very important one, and that's a big one, is selling because the stock went up. I see it all the time with many newer investors. And this is when you buy a stock, it goes up 20% in a week. What do? You take profits. Why are you taking profits? Because you're scared the stock will get back to break even. And it might work the first time, but the second time it might not work out. For example, I talked about a stock called HIMS. I've been in HIMS from $7 per share. And many people made fun of me, and they even left my investment group because I didn't sell HIMS at $60 per share. And many of them maybe sold HIMS at $60. And I told them, you guys are learning the wrong lessons. Because let's say you learn the lessons and next time I'm going to take profits when the stock goes up. Next time you're going to buy Palantir at $10. Palantir is going to go to $20. You're going to sell Palantir at $20 because you didn't sell HIMS. Okay, I'm just giving an example. But this time, Palantir is not going to go back to your cost basis of $10. It's going to go to $120. And you would have learned the wrong lesson. So the main lesson is you only need one Palantir in your life. One NVIDIA, one Tesla. You only need one of those stock that goes up 1,000% or 2,000%. But selling it just because it went up is a big mistake. You sell it when it gets like extremely overvalued, or you sell it when you believe the stock no longer has any kind of runways. HIMS at $60 was still trading around 8 times sales, 8.5 times sales, and the TAM and the growth is insane over the next 20 years in the healthcare system. They only have a 2% market share of 100 million people in weight loss, for example. So why would I have sold HIMS? It wasn't expensive. Why would I sell it? But many people, they told me I sold HIMS at $10 when it went up. I sold Palantir at $20. This is because you're paying too much attention to the price and you're not paying attention to the fundamentals and everything around it. So the truth is, I told you, you only need one Palantir in your life. So is it worth it taking this 20% gain if the stock has a potential to go up 500% or 1,000%? To me, it's not worth it. And it's very important also to not learn the wrong lesson because, oh, I should have taken profit and the stock went down. Next time you're going to take profit, the stock is not going to go back down. It's going to go up 1,000%, and you would have missed on life-changing gains just because you were so emotional that you're scared the stock will go back down, instead of you looking at the business as the long-term potential of the business and the changes in the fundamentals if they have improved relative to the price, because the stock could go up 100%. But if earnings per share went up 200%, the stock could be cheaper now than it was before it went up 100%. So again, guys, it's not just about the price, but it's also about the change in fundamentals. And that's a very important one. Number 3, very important one also. And this is a funny one. Selling because the insiders have sold. People tell me all the time, look at HIMS, man, look at Palantir, look at all those stocks. The insiders are selling. The CEO of Palantir, he sold, some stock around, was it $100, $110? That means Palantir is going to crash. Well, if you look back at Palantir as an example, back to 2023, the CEO has sold stock on Palantir around $60 per share. Palantir right now is trading around $120. So the stock went up 100% after the CEO sold his shares. Now imagine selling your shares just because the insiders have been selling. So how come HIMS insiders have been selling from $6 per share? How comes the Palantir insiders have been selling from $10 per share, but those stocks keep on going up? Why? Because of stock-based compensation. Those kind of executives, they get massive stock-based compensation. They don't need to buy back any stock. They don't need to buy any stocks. They're always going to be net sellers of their stock. So if you're just looking at insider selling, they never bought any stock, so there's no track record of they bought at this price, they sold at this price. That means it's worthless. So you could look at insider selling, but selling just because the insiders have sold, because they might know something or whatever, this is not a smart idea at all. Especially if you look at Palantir again. Imagine selling a stock at 60 just because the CEO did. Although the CEO sold at 50, he sold at 40, he sold at 30, he sold at $10, and he sold it at $8. Because they have stock-based compensation. This is HIMSS, AMD, NVIDIA, all those tech stocks. They will always be net sellers of the stock. And if they don't buy any stock, it doesn't mean they don't believe in the company. So you have to get this mindset out of your head where, even Robinhood, when I talked about Robinhood, before it went up 70%, just a few weeks ago, people told me, oh, look at the insider selling, you're going to be impressed. They've been selling Robinhood from like $6 a share. So sometimes you have to look at the record to know if this is accurate or not. And if the company is a tech company, it has massive stock-based compensation, which means insider selling, that doesn't mean anything. So I wouldn't pay attention to it. And that's an important one. Number 4. Again, this is a common one, and this one's a little bit funny. Not buying because of a recession. So I get told all the time, why are you buying any stocks, man? Why are you buying stocks? We're going to have a recession in the second half. When we have a recession, the stock market is going to crash and everything will go to zero. Why are you buying any stock? Well, I have news for you guys. The stock bottoms 9 months before earnings bottom. Stocks bottom 9 months before a recession bottoms. Why? Because the market is forward-looking. By the time everyone is expecting a recession, the S&P will bottom before the recession. And as the economy is deteriorating, there's a very high likelihood that the S&P will be going up into a deteriorating economy. This is what's happening in Germany right now. The German index is at all-time high, but Germany's economy isn't doing the best. So the economy is not the market. They do correlate with each other, and looking at the economy and economics is important, but skipping an undervalued stock just because we're going to have a recession is a very dumb idea. Trust me, look at the data. Stocks bottomed 9 months before a recession. They bottomed in 2009. In 2009, stocks were going up as we had 2 quarters of negative GDP. So GDP was negative in 2009, but stocks were going up. Why? Because we priced it in. So as long as it's not some kind of a financial crisis or something crazy, stocks tend to bottom before a recession most of the time, before earnings most of the time, because the market is forward-looking, especially if the Fed is easing, is cutting interest rates, is expanding the balance sheet. Stocks will look beyond whatever bad is happening, and they will go up in anticipation of something better for the future, because the market is forward-looking, and it's not much about, oh, we're going to have a recession, that means the stock market is going to crash. It could happen, but it's not necessary. And the market and the economy, they're not really the same. Like, they're a little bit different, because the stock market goes down before the economy kind of really shows major signs of deterioration. And it goes down in anticipation of those deteriorations. So that's how I would explain it. Number 5, and this is a very important one, and some of you guys may disagree with me, and I'm not trying to generalize, because I know many of you guys are more open-minded and things like that, but I think most investors in general in the market, they're not open-minded. They kind of live in their own bubbles. This is why we have growth investors, value investors, quality investors, those kind of investors. This is why we have investors making fun of each other on X instead of trying to learn from each other. So, for example, the growth investors, they don't want to listen to the value investors because they underperform. The value investors, they want to make fun of the Palantir investors because Palantir is a piece of trash and they missed out on Palantir. So they don't want to listen to them. But I'm just going to tell you one thing, guys. I started as a value investor. How did I find HIMSS at $7 per share? How would a value investor like me that invested in stocks you guys would never touch, below liquidation value, funeral home companies, terrible kind of companies you wouldn't touch, as a value investor, I bought those stocks. How did I buy Robinhood last month before it went up 70%? How did I make 27% in 2022? By recognizing a technical pattern, which tends to show that whenever this trend line tends to break, this is when most of those market crashes tend to happen. And it happened again in 2024. And very few people have listened to me, but I'm still up 11% year to date. Now, how did I learn all those things? By being open-minded, by listening to people that I disagree with, by listening to people that know something more than I do. So if I meet a technical analyst, I don't say that most value investor would say, oh, he's just timing the market, it's all noise, no one can time the market. I want to learn from him. If he knows something, he had a good record, maybe there's some things I can learn. If I meet a Palantir investor, he's been invested in Palantir from $6 per share, I'm not going to judge him. I'm not going to call Palantir trash or call him whatever, pumper or some kind of things that people say. I want to learn from this person. How did you find Palantir at $6? Because maybe I can use what you did to implement it in my strategy to find the next Palantir. So the way I learned all those things as a value investor is by being open-minded. By whenever I meet someone that knows more than I do, I just shut up and listen. I'm not going to argue with them. I'm like, it's free to listen, so I'm going to listen. And if I like what I'm hearing and if I see good results, maybe I can implement some of it in my strategy. So this is a very different mindset from being stuck in your own bubble. Oh, I'm a value investor, everything else is just noise. Oh, this guy is showing charts, he's trying to time the market. No one can time the market. I'm like, just listen to him, man. Maybe there's something you can learn. Maybe there's something interesting you didn't know. I mean, it's free to listen. And if he has a good record, why don't you listen? So this is a very important one. And I think if more people are open-minded in the market, we can all learn, use the internet to learn from each other instead of, being stuck in our own bubbles and believing that we know everything and everyone else doesn't know what they're talking about and all these things would be very helpful. But that's all I have to say for this video. If you want more of what I like to do when I'm buying something, when I'm selling something, more valuation tutorial videos, I share everything I do in my own group. This is the link if you're interested. So thank you for watching. Hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.